Many novice investors are drawn to the excitement of investing in individual stocks and shares, but is this the right approach? Should you invest in index funds instead?
In this video, we're going to discuss whether retail investors, that's you and us, should be investing in index funds or individual stocks and shares. Let's check it out.
Welcome to Money Unshackled, the investment channel that sets you and your finances free. I'm Andy, this is Ben, and if you like what we say, hit the like button and click subscribe. Let's get into it.
Firstly, what is an index fund? An index fund is a collective investment such as an open-ended investment company, unit trust or ETF that tracks a specific asset type such as a stock, bond or other investment class. For example, a FTSE 100 index fund would buy shares in all 100 companies in the FTSE 100 in order to replicate the performance of the index as a whole. They are also commonly known as index trackers.
So let's get straight to the point. Which is best, index funds or individual stocks? Without doubt, or at least in our opinion, an index tracker is by far a superior investment approach than buying individual stocks for most people. That's not to say that you shouldn't invest in individual stocks at all, but the majority of your investment should be tracking an index or multiple indices.
So why invest in index funds? Number 1, time. Choosing and managing your own large investment portfolio can take a lot of time and energy. It involves scrutinizing the business activity of a company when you buy it and then on an ongoing basis. Why bother when you can just buy into an index fund and make your investments passive?
Number 2, low cost. Buying lots of stocks will be very expensive. Theoretically, once you own the stock, there will be no further fees, but in reality, this is not the case. A portfolio will need to be regularly rebalanced, which can be very expensive if you have a large portfolio. However, an index fund, which invests in maybe hundreds or even thousands of companies, will rebalance for you, all for a very low fee.
Number 3, diversification. If you are constructing your own portfolio, it is very unlikely that you will be able to diversify it enough to mitigate risk. As we have just seen, tracker funds can come with enormous diversification. For instance, if you were to buy an S&P 500 tracker, you would immediately have diversification across 500 companies.
Number 4, lack of expertise. Let's be honest, most of us have little to no experience when it comes to picking stocks that perform. Some people would just pick stocks that excite them or even ones they've just heard of. Another bad strategy is to invest in a company simply because the share price has fallen, because they always expect that the share price to increase, but this isn't always the case. If you invest in a stock without evaluating it properly, then you are gambling and not investing.
Why bother making these mistakes when a tracker eliminates the need for expertise? Tracker funds have empowered the retail investor so that they can often beat the pros.
Number 5, no stamp duty. When you buy UK stocks, you have to pay stamp duty at 0.5%. However, when you buy funds such as ETFs, you do not have to pay this stamp duty, albeit the fund has to pay it when they initially buy the stock. This allows you to keep tax to a minimum, which is always handy.
Why invest in individual stocks? Number 1, potential for huge returns. The main problem with tracker funds is that by definition they track an index, so you can't outperform the market. Whereas if you were to invest selectively in individual stocks, there is the potential for huge gains. Just imagine the gains if you were to invest in a startup pharmaceutical company that were to find the cure for cancer, or if you were to invest in a technology company that discovers a replacement for petrol.
Number 2, more exciting. Let's face it, investing in a stock is far more exciting than investing in a tracker. It can be a bit of a roller coaster watching the share price react to news, and you do get an emotional attachment into companies that you've invested in. However, emotion often leads to bad investment decisions.
Number 3, you can avoid a market crash. Another problem with index trackers is that it tracks the market as it crashes. However, if you can predict when a market is likely to crash, then there is no point in keeping your money locked into the market while this happens. Some people are so good at investing that they are able to get positive returns even during market downturns.
Our preferred approach is to use what is known as a core and satellite investment strategy. This is essentially where the bulk of your portfolio consists of passive index funds. This is known as the core. Then you invest in a few individual stocks which make up the satellites. The purpose of the satellites is to outperform the market.
This strategy is passive, relatively safe, and yet has the excitement that keeps investing interesting. Question of the day: what do you like to invest in and why? Let us know in the comments section.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is Money Unshackled. See you next time.